Okay, today we're getting into something huge, something you really can't avoid anymore. Cryptocurrency.
Yeah, it's everywhere, isn't it?
Totally. The headlines are just wild. You see assets going from like basically nothing, pennies, to tens of thousands of dollars.
And the crashes, wiping out billions
Yeah.
like that.
The volatility's, well, it's almost unbelievable sometimes.
So for you listening, our goal today is really to cut through that noise. We want to look at, where this all started, the origin story. Explore how this market actually works. It's 2047, totally different. Look at how people made these, frankly, insane fortunes.
And lost them too, right?
Absolutely. And maybe most importantly, we need to cover the survival tactics. What you absolutely need to know to avoid getting, well, wrecked in this space.
So the core tension here seems massive. Is this like a genuine financial revolution that's unstoppable?
Or is it just, the biggest, most dangerous gamble we've seen in ages? A massive bubble waiting to pop.
That's the question. Let's dig in.
Okay, origins. Where do we start?
Well, the story really begins almost like a jerk, doesn't it? Bitcoin, back in what, 2009?
Yeah, 2009. This anonymous creator, Satoshi Nakamoto. Nobody even knows who that is, really.
Still don't.
Still don't. And it was built on blockchain technology, which was, revolutionary stuff. But for years,
Worthless.
pretty much, just dismissed as internet money. You couldn't easily buy it. People were literally giving it away or mining thousands for almost zero cost.
Which makes the later explosion in value just staggering.
It really does. And that initial disbelief, that zero value phase, is key to understanding the shock that came later.
Nothing shows that shock better than the Bitcoin pizza story, right?
Oh, yeah. Bitcoin Pizza Day, May 22nd, 2010. Gotta love it.
This guy, Laszlo Hanyecz, pays 10,000 Bitcoin for 2 Papa John's pizzas.
Which cost him, what, maybe $40 at the time, something like that?
$40 then. But what would those 10,000 Bitcoin have been worth later?
Okay, get this. At the peak in 2021, over $600 million.
600 million for 2 pizzas. Ouch.
Yeah. It's probably the most expensive meal in history. It kind of fuels the whole what-if dream for everyone in crypto, doesn't it? That FOMO.
It really crystallizes the scale, the sheer potential volatility. Let's trace that growth quickly. It hits $1 in 2011, then $1,000 by 2013.
Already a huge jump.
Then the 2017 mania, nearly $20,000.
And then the big one, 2021, it peaks near, what was it, $69,000.
Almost $69,000 per coin. Insane. And this exponential rise, it created these overnight millionaires, like Eric Finman.
Yeah, the kid who put in like $1,000 when Bitcoin was maybe $10.
I was a millionaire before he turned 18.
That sounds like a fairy tale. But, and this is crucial, for every story like Finman's, there's a nightmare counterpoint.
You mean loss?
Devastating loss. Often just down to simple human error. Like the guy in the UK.
Oh, the hard drive story.
Yeah, accidentally threw out a hard drive with 7,500 Bitcoin on it.
Which today is worth hundreds of millions.
Hundreds of millions, yeah. Sitting in a garbage in a landfill. And he's still trying to get permission to excavate it.
Wow. Fortunes made, fortunes lost, just like that. On a single click or a single mistake.
Exactly. Attention and inattention become multi-million-dollar factors.
Okay, so we know it's incredibly volatile. But how does this market actually tick? Why is it so different from, say, the stock market?
The core difference is the tech itself, the blockchain. That's why it runs 24/7, 365.
Right. No opening or closing bell.
Nope. It's a decentralized global ledger. It doesn't need banks or traditional market hours to verify anything. It just runs. It cuts out the middleman. That's the whole idea behind DeFi, decentralized finance.
Okay, wait. So 24/7. How does that constant on status change things for someone investing? That must create enormous pressure.
Oh, absolutely. Constant urgency. That fear of missing out, FOMO, is baked into the system.
Because your coin could double while you're asleep.
Or crash. Instantly. While you're offline, have a dinner, whatever. This nonstop nature fuels the crazy price swings. We're talking 50% moves in a single day sometimes. That's not rare here.
Can you give an example of that speed?
Sure. Look at Dogecoin. Started literally as a joke, a meme.
Right, the dog coin.
The dog coin. But fueled by hype, social media, it exploded over like 12,000% in just a few months in early 2021.
12,000%.
Yeah. But then, just weeks later, you see Bitcoin itself, the king, drop almost 50% of its value. It's pure whiplash.
And it's not just about numbers, is it? It reacts to culture, news.
Totally. Traditional markets look at earnings reports, economic data. Crypto, it moves instantly on tweets, news headlines, celebrity endorsements.
Like Elon Musk and Dogecoin.
Exactly. His tweets sent Doge soaring. Or think about regulatory news. China bans mining, prices tank. El Salvador adopts Bitcoin, prices spike. It's this incredibly sensitive, high-speed feedback loop, very emotional.
Okay, so trading happens on exchanges, right? Centralized ones like Coinbase.
Yeah, Coinbase, Binance, those are the big centralized ones. Or you have decentralized exchanges, DXs like Uniswap for peer-to-peer stuff.
What are the key things people track, like market cap?
Market cap, definitely. Price times the number of coins. Trading volume is huge, too, shows interest, activity.
And liquidity, you hear that term a lot.
Liquidity is critical. It's how easily you can buy or sell without tanking the price. But in crypto, especially with smaller coins, low liquidity is dangerous. It means a few big players, whales, can make huge trades.
To manipulate the price.
Precisely. They can pump the price up, create hype, lure in small investors based on that rising market cap, and then dump their coins, crashing it. You have to watch the liquidity very carefully.
And quickly, there's a difference between coins and tokens. Yeah.
Good point. Yes, coins like Bitcoin or Ethereum have their own blockchain. Tokens, like most meme coins or project tokens, are built on top of existing blockchains, usually Ethereum. It's much easier to create a token.
Okay, that makes sense. So let's shift to the fortunes. Beyond just buying Bitcoin early, what are the actual strategies people use to get rich here?
Well, you can break it down. Strategy 1, pure trading. High risk, high speed.
Buying low, selling high, but super fast.
Exactly. Because the swings are so massive,
Yeah.
a good trader could potentially make in hours what a stock trader makes in months. But
The losses are just as fast.
just as fast. You're riding lightning, constantly exposed.
Okay, what's next? Less risky.
Relatively. Strategy 2, HO dealing. The classic. Just hold on for dear life.
So buy something you believe in and just wait. Ignore the noise.
Pretty much.
Yeah.
Many of the biggest crypto fortunes were made this way. People who bought early and just refused to sell, riding out massive crashes.
That takes nerves of steel, though.
Phenomenal discipline. Look at Ethereum. Launched around 75 cents in 2015, peaked over $4,800 in 2021.
Wow, what is that, like 6,000 times your money?
Roughly, yeah, 6,000x. Not from frantic trading, but from patience through unbelievable volatility.
Okay, so HO dealing is passive waiting. But can you make your crypto work for you while you hold?
You can. That brings us to strategy 3, staking and yield farming. More passive income plays.
Staking? That's like locking up your coins.
Exactly. You lock up your coins to help secure the network, validate transactions. In return, you earn rewards, often like 5% to 15% annual percentage yield. Pay to more coins.
Okay, and yield farming.
Riskier, but potentially higher returns. You're essentially lending your crypto out on decentralized finance or DeFi platforms. Think of it like being the bank, but the risks of platform failure or bugs are much higher.
Got it. Then there was that whole NFT craze. Strategy 4.
Yeah, the NFT boom. The digital gold rush, you could call it.
That artist Beeple selling one for $69 million really put it on the map.
It did. Suddenly digital art, collectibles, they had provable scarcity on the blockchain. Early buyers of collections, like CryptoPunks,
They paid a few $100 initially.
sometimes less, and saw them rocket to hundreds of thousands, even millions, purely based on hype, community, and perceived digital value.
Wild. Okay, 5th strategy. This one feels the most chaotic. Meme coins.
Ah, yes, the meme coins. This is where things get truly absurd and where that coin versus token distinction matters.
Because they're mostly tokens. Easy to create.
Exactly. Often started as literal jokes. Dogecoin, Shiba Inu.
But the gains were astronomical.
Beyond astronomical. Doge did that 12,000% run. Shiba Inu, some early holders saw gains of, wait for it, up to 40 million%.
40 million. That's not even, I can't process that.
Nobody can. A tiny, like $10 bet turning into millions, purely on social media momentum and collective belief. It's gambling disguised as investing, mostly.
Which feels like the perfect pivot to the dark side. Because if gains like that are possible,
Then catastrophic losses must be too. And they are. This is critical. In crypto, the ultimate risk isn't just losing some money, it's getting wrecked,
wrecked, meaning
meaning the coin goes to zero. Total wipeout. Unlike a blue chip stock, many altcoins can and do just die completely.
we need to talk about some specific disasters then to really understand the risk. Terra Luna in 2022 seems like the big one.
It's the essential case study. Luna was huge, a top 10 project, billions in value. It relied on this linked stablecoin called UST.
Stablecoins are supposed to stay pegged to $1, right?
It's those two. But UST was algorithmic. It wasn't backed by real dollars. It used Luna tokens and code to maintain its $1 peg.
And the code failed.
The mechanism failed under pressure. When people started losing faith in UST and selling it, the algorithm was designed to print infinite amounts of Luna to try and buy UST back and stabilize the price.
Infinite printing. That sounds bad.
It's a death spiral. More Luna supply crashes the Luna price, which causes more panic, more UST selling, more Luna printing. The whole $40 billion ecosystem evaporated in days. People lost life savings, homes. It was brutal. Engineered self-destruction.
And it's not just the coins themselves, it's the places you trade them, right? Exchanges can collapse.
Absolutely. Centralized exchanges are a huge point of failure. We saw it way back in 2014 with Mt. Gox.
What happened then?
250,000 Bitcoin just vanished. Hacked or stolen, gone.
Wow. And then more recently, FTX in 2022. That was massive news.
FTX shook the whole industry. It wasn't a hack. It was alleged fraud. Billions in customer funds apparently misused, gambled away by its sister trading firm. When the truth came out, it collapsed, freezing everyone's assets.
Which hammered home that crypto mantra.
Not your keys, not your coins. It means everything. If your crypto is sitting on an exchange, you don't truly own it. You're trusting the exchange.
And that trust can be broken.
Easily. Or developers can do a rug pull, launch a token, get people to invest, then drain all the money and disappear. We saw the Poly network hack too. Over $600 million stolen. Theft and scams are constant threats.
On top of all that, there's just human emotion, isn't there? Making bad decisions under pressure.
That's maybe the biggest killer of crypto dreams. The sheer volatility weaponizes fear and greed.
FOMO makes you buy the top.
And panic makes you sell the bottom, locking in losses. People abandon their plans constantly because the emotional swings are just too intense. Often it's not the market that beats you. You beat yourself.
Okay, this is heavy stuff. Let's pivot to solutions. How do you navigate this chaos? Let's build the crypto survival kit. Rule number 1 seems obvious after Luna.
Absolutely non-negotiable. Golden rule #1.
Yeah.
Never invest more than you can afford to lose. Period.
Treat it like speculation, like venture capital, not saving.
Exactly. Seeing people lose homes over Luna proves this point. Don't bet the rent money. Ever.
Okay, rule 2.
Diversify. Don't put all your eggs in one volatile basket. Especially not one altcoin or exchange token.
Like people who went all in on FTX's FTT token.
Yeah, they got wiped out. Over 95% loss. Spread your risk. Maybe keep a core in Bitcoin or Ethereum, then smaller bets elsewhere if you must. It's basic risk management.
Rule 3. Learn before you leap. Don't just buy based on hype.
Please don't. If you see something trending on social media, that's usually a sign it's already peaked. Understand the project, the tech, the team, the tokenomics. If you don't get it, you're just gambling blind.
Rule 4 sounds like it comes directly from the FTX and Mt. Gox stories.
It does. Protect your coins. Get them off the exchanges.
Use a hardware wallet, like Ledger or Trezor.
Yes. Store your private keys offline. That way, you control the assets. If the exchange gets hacked or goes bankrupt, your coins are safe because they're not there. Remember, not your keys, not your coins.
Makes sense. Rule 5 targets that emotional roller coaster.
Control your emotions. Easier said than done, but vital. Have a plan, stick to it. Don't chase pumps when things are flying high. Don't panic sell when things dip.
Like the people who sold Bitcoin at $3K in the crash thinking it was dead.
Exactly. They missed the run to 69K. Calm hands often win in the long run.
And the final rule, Rule 6. Sounds like common sense, but...
Be skeptical, especially of unbelievable promises. If a project guarantees huge returns like 20% a month,
run away
fast, it's almost certainly a Ponzi scheme. Think BitConnect, a massive crypto Ponzi that collapsed spectacularly. If it sounds too good to be true in crypto, it absolutely is.
Okay, so armed with those rules, where does this leave us? Back to the big question. Revolution or just a massive gamble?
Well, the revolution camp makes comparisons to the early internet in the 90s. Dismissed as a fad, then it changed everything.
And there are real-world uses emerging beyond just speculation, right?
Definitely. We talked about DeFi banking without banks. NFTs are proving digital ownership in new ways. Cross-border payments are faster and cheaper, especially for migrant workers. That's real utility.
Plus, big companies, even countries, are getting involved.
Yeah, Tesla, PayPal dipped their toes in. El Salvador made Bitcoin legal tender. Major banks are now offering crypto services to clients. Mainstream adoption is happening, slowly but surely.
But the risk hasn't vanished. The predictions are still all over the place.
Totally polarized. You have experts predicting Bitcoin at $500,000, even $1 million per coin eventually.
And the other side?
The other side says harsh regulation could crush it, or a better technology might just replace Bitcoin and current blockchains, setting them towards zero. The uncertainty is still massive.
So wrapping this up, it feels like crypto is this wild frontier.
It absolutely is. Technologically, financially, psychologically. It's where cutting-edge tech meets raw human emotion, greed, fear, hope at incredible speed. The potential is shocking, but the risks are just as profound and unforgiving.
And the story is far from over, isn't it? We could be watching the biggest shift in wealth in modern times unfold right now. So the real question for you listening, are you going to stay on the sidelines and just watch? Or, armed with this knowledge, are you maybe going to take that calculated risk, that informed gamble, and actually be part of whatever this revolution turns out to be?